Private markets are evolving faster than ever, and investors everywhere are asking what comes next. I am Tanvi Gupta, and this is Private Market Realities, powered by Liquidity.io. This is the podcast where we decode the evolving world of private markets and alternative investment. Now, I know for many of you listening, whether you are a seasoned investor, someone just starting to explore alternatives, or even just curious about what private equity really means, it can sometimes feel like there is a wall of jargon between you and the answers you need. So, in this episode, we are breaking down those walls. We will talk about what private equity really is, the challenges private equity is facing today, and the opportunities investors are watching for in 2025. Our guest today is Pooja, a product manager shaping how private markets are experienced by investors. From designing tools that make investing more transparent to understanding how firms operate behind the scenes, she brings a hands on perspective that goes beyond the headlines. Pooja, welcome to the show.
Thank you, Tanvi. I'm so excited to be here. Private equity is at such a fascinating point right now. It's facing real headwinds, but also some of the most interesting opportunities I have seen in years. And I think that makes it perfect moment to have this conversation.
Before diving deeper, it's important to get the fundamentals right. I will be honest, whenever I hear private equity, I think of this big mysterious world with so many terms flying around. Primary funds, secondaries, co investment. It is easy to get lost. I'm sure many of our listeners feel the same. Like, what does this actually mean for me as an investor? Could you break it down in simple terms? Can you walk us through the different types of private equity investment and explain how primary, secondary, and co investment work?
Absolutely. Let's think of private equities as three different dining experiences. Primary investments are like going to a brand new restaurant on opening night. You are trusting the chef. You don't know exactly what dishes will come out, but you believe in their vision. That's what happens when you commit to a new fund. The risk, you are investing blind because you don't know the exact companies yet. But the reward is you are in from day one and you can benefit from the entire growth cycle. Secondary investments are more like walking into a restaurant after reading all the reviews and seeing the menu. Someone has already tested the dishes and is willing to sell you their table. You can look at the companies already in the fund and make more informed choices. The investments are usually closer to maturity, so the risk is lower and the returns often come quicker. Co investments are like picking one dish off the menu, saying, I will share this with chef. Here, you invest directly into a company alongside a fund. You usually pay lower fees and get very targeted exposure, say a promising healthcare startup or a logistic company that transforming its sector. So, the real question for investors, do you want to bet early and do you want visibility and speed or do you want direct exposure from more control?
Now, let's zoom out a bit. When I look at the headlines, rising interest rates, inflation, fewer IPOs, it feels like private equity is really under pressure. I think the big question for many of us is how is this really working right now? Firms struggling to raise money? Are deals actually happening? How are you and your team adjusting?
That's a very real concern. Few years ago, raising a fund could take 3 to 6 months. Today, it can stretch to almost 2 years. Investors are much more cautious. They want detailed due diligence. They want to see the track records and they are slower to write checks. On exits, it's true. IPO are sluggish, but firms are finding alternatives. We are seeing more strategic sales to corporate or sales to other PE firms. We call those sponsor to sponsor deals. There's also a rise in continuation funds, where a firm can keep a strong company in its portfolio longer while still giving some liquidity to investors. And valuation, much harder. In a low rate environment, firms could rely on financial engineering. Today, it's about true operational improvements, fixing supply chains, digitizing sales, and improving cost structure. So, yes, it's tougher, but in a way, it's healthier. It forces firms to be more disciplined and focus on actual value creation, not just quick financial tricks.
Your team focuses on small and mid sized companies, but for many listeners, private equity usually brings to mind massive deals that grab attention, not this side of the market. So, why focus on small and mid market deals? What's special about this segment?
Such a good question. The reality is, small and mid sized companies are the backbone of the economy. In the US alone, there are over 130,000 businesses with 10 to $100 million revenue. That's huge. And here's why they matter. They are often family owned, and private equity is their first experience with outside capital. That creates a lot of opportunity for genuine partnership. They are usually less leverage than large cap companies. That means the focus is making them better, stronger management, better processes rather than just pilling on debt. The entry prices are typically 20% lower than big buyouts. So the risk return profile is often more attractive. And frankly, this is where private equity makes the most visible impact. You can take a solid regional company and help it become a national leader. That transforms feel much more tangible than just shifting numbers around in billion-dollar deals.
Let's talk about something every investor cares about exit. IPOs are slow, but people still want liquidity. If I'm an investor, I'm wondering how will I get my money back and when? So, how are firms managing exit in this environment?
Right now, firms are getting creative in strategic sales, sponsor to transactions, continuous funds, even dividend recap. In strategic sales, selling to corporates who wanted to expand. Sponsor to sponsor transactions, like selling from one PE firm to another. Continuation funds, letting a fund hold a strong company longer while still providing some liquidity to existing investors. And the dividend recaps, where the company borrows and pay cash back to the investor without full exit. So it's not straightforward as IPO or bust. It's more like winding road with multiple pathways. The timelines are longer, but investors are still finding liquidity. It just requires more patience and flexibility.
You mentioned earlier that fundraising takes longer now. At first glance, that sounds like a headache, but I want to flip the question. Does it also give you an edge? Does the slower pace actually help you do better due diligence?
That's exactly right. Slower fundraising means we don't have to rush. We can dive deeper into companies' financials, culture, and operational risk. It also gives us more negotiation power on co investments. In a fast market, sometimes firms chase deals just to deploy. In today's environment, there is space to say no more often. That discipline ultimately builds stronger portfolios. So, yes, it's harder, but it's also making the industry more resilient.
I can't end without asking this. Technology and AI are everywhere, from supply chains to social media. It is changing everything. How is private equity using AI to actually create value?
So it's massive. AI is moving from buzzword to actual application. For example, companies are using AI to optimize supply chains by predicting demand and avoiding overstock, improve sales targeting with smarter customer data, automate repetitive tasks, freeing up employees for higher value work. Private equity firms are hiring data scientists, embedded tech teams, and even building AI playbooks for portfolio companies. The big shift is returns are no longer driven by leverage alone. They are driven by operational excellence, and AI is huge part of that toolkit.
Okay, let's wrap up by looking ahead. If I am an investor listening today, what should I be watching in the next 1 to 2 years?
There are four big themes to keep an eye on. Geopolitics and interest rates, they will shape capital flows. Inflation pressure, still very real. AI that is accelerating across industries. ESG and sustainability, not just a buzzword, but increasingly tied to long term value. For investors, the key is to stay patient, disciplined, and focused on where true operational improvements are happening. That's where the best opportunities will emerge.
Patience, discipline, and insight. I love that. That's all for today's deep dive into private equity with Pooja. Thank you so much for joining us and breaking this down so clearly.
Thank you, Tanvi. This was a lot of fun.
And to our listeners, thank you for tuning in to Private Market Realities. Don't forget to subscribe on YouTube and follow us on LinkedIn and stay connected with liquidity.io for more expert insights on private market investments. Until next time, stay curious, stay invested.